This learning objective will describe the 4 financial statements as well as how they are prepared. The 4 financial statements are as follows. We have the income statement, which reports revenue, expenses, and net income or loss. It tells us how well a company performed during a period of time. The next financial statement is the retained earnings statement, and this statement tells us how much of income was distributed to owners in the form of dividends and how much was retained in the business for future growth. The third financial statement is the balance sheet. This financial statement reports assets, liabilities, and stockholders' equity. It reports a company's financial position at a point in time. And then lastly, the statement of cash flows reports the inflows and outflows of cash during a period of time. To introduce you to the 4 financial statements, we will look at an outdoor guide service, Sierra Corporation, after their first month of operations. Sierra provides guide services such as rafting and hiking in the Lake Tahoe area of the Sierra Nevada mountains. Let's take a look at Sierra's financial statements for its first month of business. The income statement reports a company's revenue and expenses and resulting net income or loss for a period of time, such as a month, quarter, or year. In this instance, it's for the month ended October 31st. We determine net income or net loss by deducting expenses from revenue. The financial statement reports the success or failure of the company's operations. It essentially assesses performance. If revenue exceeds expenses, the result is net income. If, however, expenses exceed revenue, the result is a net loss. The last thing I want to mention is the structure or the heading, which identifies the company, the type of statement, in this instance it's the income statement, and the time period covered. Sometimes there'll be a 4th line item which indicates the unit of measure, for example, in thousands or in millions. The retained earnings statement shows the amounts and causes of changes in retained earnings for a specific time period. In this instance, it's for the month ended October 31st. The beginning retained earnings amount appears on the first line of the statement. In this instance, it's 0. The company then adds net income and deducts dividends to determine the retained earnings at the end of the period. If I were in the classroom, I would write this on the board. Beginning balance plus net income minus our dividends equals our ending balance. Again, you must know this formula. As I just stated, the retained earnings statement reports the changes in retained earnings during a period. The time period is the same as that covered by the income statement. In this instance, it's for the month ended October 31st. It reports the amount paid out in dividends and the amount of net income or net loss for a specified period of time. Ending retained earnings represents net income since the inception of the business that has not been paid out in dividends. Essentially, I want you to think of this as the amount of earnings that has been reinvested in the business. And then the last thing I just want to mention, if a company has a net loss, it will deduct that amount from the retained earnings statement as opposed to adding it. The balance sheet shows the relationship between assets and claims on assets, which include liabilities, that would be the claims of the creditors, and stockholders' equity, which would be the claims of the owners at a specific point in time. In this instance, it's October 31st. Assets and claims, liabilities, and stockholders' equity must equal. The ending balance in retained earnings is needed in preparing the balance sheet, more specifically, the stockholders' equity section. The balance sheet presents Sierra's financial position as of October 31st. It reports assets and claims to assets at a point in time. This relationship is where the name of this financial statement, balance sheet, comes from. Assets must equal liabilities and stockholders' equity. The balance sheet lists assets first, followed by liabilities, and then stockholders' equity. Stockholders' equity is comprised of two parts: common stock, which is also referred to as contributed capital, and retained earnings. Common stock results when the company sells new shares of stock, and retained earnings is the net income that has been retained in the corporation. Sierra has common stock of $10,000 and retained earnings of $2,360 for a total stockholders' equity of $12,360. The basic accounting equation, assets equals liabilities plus stockholders' equity, is a very important concept. If we were in the classroom, I would give each of you a ginger ale. And I would go on to say, if you drink too much ale, you get out of balance. Right? The balance sheet is where you'll find ale, assets, liabilities, and equity, or stockholders' equity. If you want to think about if you drink too much ales, right, you become out of balance. Again, accountants drink ginger ale to make sure the balance sheet balances. Again, assets, liabilities, and stockholders' equity, you have to know this. You have to know that assets must equal liabilities plus stockholders' equity, and that's the best I can come up with to help you remember this equation. The basic accounting equation, where assets equal liabilities plus stockholders' equity, is just an equation. The components can be moved in the same way the components of an algebraic equation can be moved. Let's talk more about stockholders' equity. It is equal to total assets minus total liabilities. The assets of a business are claimed by either creditors or stockholders. To find out what belongs to stockholders, we subtract creditor claims, the liabilities, from the assets. The remainder is the stockholder's claim on the assets. It is often referred to as residual equity, or the equity left over after creditor claims are satisfied. You will solve for stockholders' equity by subtracting liabilities from assets on one of your homework problems. Right, assets are the resources owned by the business. I want you to think of this as things of value. An example of assets are cash, accounts receivable, inventories, and equipment. Liabilities are creditors' claims against assets. They represent a company's debts and obligations. Businesses usually borrow money from a bank, and we would use the account note payable. They also purchase merchandise on credit, in which case we would use accounts payable. Stockholders' equity represents the owner's claims to assets. The stockholders' equity section of a balance sheet generally consists of common stock, which is often referred to as our contributed capital, and retained earnings, which is often referred to as our earned capital. A corporation may obtain funds by selling shares of stock to investors. Common stock is the term used to describe the amount paid in by stockholders for the shares they purchased, and retained earnings represents the income that has been retained or reinvested in the business. The retained earnings section of the balance sheet is determined by three items: revenue, expenses, and dividends. A, B, D, and E are easy and straightforward. You will either add or subtract the two in numbers to arrive at the solution. Part C and F require some additional instruction, which will be provided on the next slide. You will need the expanded equation to solve C and F. In the expanded equation, we actually break our stockholders' equity into the two components, common stock and retained earnings. Since we assume all changes in stockholders' equity are due to changes in retained earnings, we can ignore common stock. All right, so what you're going to do is you're going to use the following formula. Our beginning stockholders' equity plus revenues minus expenses minus dividends equals the ending stockholders' equity. So again, you're just going to fill in the numbers that you have and essentially solve for the unknown. You typically see a question like this on the exam, so do me a favor and pause this and try and solve this question. The solution is $307,000. Again, we know that we had assets at the beginning of the year of $380,000 and we had liabilities of $248,000. That means our equity at the beginning of the year is $60,000. We also know that during the business, right, we incurred $635,000 in revenues. Again, we're going to increase our revenues. Our expenses are going to reduce our equity, and so will our dividends of $59,000, so that at the end of the accounting period, or at the end of the year, the stockholders' equity is $307,000. The statement of cash flows reports the cash receipts, inflows, and cash payments, outflows of a business for a period of time using these categories: operating, investing, and financing activities. In addition, the statement shows the net increase or decrease in cash during the period and the amount of cash at the end of the period as well as at the beginning of the period. We introduced the statement of cash flows in this chapter, and then what we'll do is we'll actually revisit the statement of cash flows in Accounting 2, and there's a whole chapter dedicated to the preparation of this financial statement. Because the results on some financial statements become inputs to other statements, the statements are interrelated. The retained earnings statement uses the results of the income statement. Net income is added to the beginning amount of retained earnings to determine ending retained earnings. The balance sheet and retained earnings statement are also interrelated. The ending balance on the retained earnings statement is the amount reported on the balance sheet as retained earnings. Finally, the statement of cash flows shows how the cash account changed during the period. The ending amount of cash shown on the statement of cash flows must agree with the amount of cash on the balance sheet. To prepare financial statements, you must understand the sequence in which these amounts are determined and how each statement impacts the next. Before you prepare the financial statements, identify each account as an asset, a liability, stockholders' equity, revenue, or an expense. So for example, accounts receivable, I hope when you see that you immediately think asset, which means you're going to report that account and that amount on the balance sheet. Let's take a look at the next two. We have service revenue. Again, that's going to be a revenue. And we have advertising expense. Right, you're going to report those amounts on the income statement. The solutions will be provided in the next video. Publicly traded U.S. companies must provide shareholders with an annual report. The annual report always includes the financial statements introduced in this chapter, and it also includes other important information such as management's discussion and analysis, notes to the financial statements, and an independent auditor's report. No analysis of a company's financial situation and performance is complete without a review of these items. The MD&A section presents management's views on the company. I like to think of this report as seeing the company through the eyes of management. The notes to the financial statements clarify the financial statements and provide additional detail, such as descriptions of the significant accounting policies, as well as explanation of uncertainties and contingencies. The notes are essential to understanding a company's operating performance and financial position. An auditor's report is prepared by an independent outside auditor. It states the auditor's opinion as to the fairness of the financial statements, as well as if they are in conformance with generally accepted accounting principles, or GAAP. Remember, those are the rules that we must follow when we prepare our financial statements.